Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 6th of November. I'm Daniel Lam, your host for the podcast. I want to dig deeper today into the current US earnings season. I want to focus upon the tech stocks and give some high-level observations. Now, overall, the earnings of the US technology companies have been strong. We have a top-of-mind stock list, and the tech companies there have beaten their estimates for the third quarter of this year. However, guidance has been more important in driving the share price versus the earnings beat. And investors do look at how companies have been guiding their earnings historically. So companies that have been guiding conservatively in the past would be sought after if they guide strong for the fourth quarter. And for those that have been guiding aggressively previously, if they're giving somewhat unexciting guidance, even if their third quarter earnings was a strong beat, investors will be taking profit on them. Now, CAPEX is the other buzzword. We see that CAPEX from the hyperscalers remains strong, and that underpins the bullish thesis on the entire AI ecosystem. However, US technology stocks have high valuation, and at such expensive levels, the nature of how CAPEX is being used is getting increasingly scrutinized. So are the companies able to get their investments back with good profit? Is the CAPEX being used to enhance profitable areas, or is the CAPEX being used to fend off competition? Yes, particularly for those companies that are facing competition from, for example, from OpenAI. High CAPEX spending does not bode well in those cases. So there are nuances that can differentiate the US technology stocks. Visibility is another key factor, especially for this year. This clarity factor can mean so much for investors. So remember the beginning of the year when investors were highly concerned about Trump 2.0 and the trade war. Fast forward 10 months to now, the trade tariff is higher than the beginning of the year, but so are global equities. It is because the path is arguably less murky than the start of 2025. Same for investors looking at company results. If a company has strong backlog and orders, it is seen as a strong sign of demand and clearer path ahead. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.